Do you need life insurance once you're retired? I'm Mark Sabrin from Canada Wealth Management. Let's dig into it. Life insurance is an important consideration for many people, and as you reach retirement age, the question as to whether or not you should keep your coverage becomes even more complex. Today, we're looking at the pros and cons of holding life insurance once you're retired and whether or not it makes sense for you. All right, so let's look at the reasons why people buy life insurance in the first place. One of the main reasons that people buy life insurance is if they have dependents, such as their spouse or children, then a life insurance policy can provide the family with financial security in the event of your death. Additionally, if you have outstanding debts or financial obligations, then a life insurance policy can make sure that those debts are taken care of. So in both of these scenarios, life insurance is used to create an estate to make sure that your family is taken care of. However, once you are retired, you may have little income or debt to insure. Let's run through an example. Bill and Sandra are both 66 years old. Now, for the sake of this example, let's say that Bill passes away. Here are the sources of income and assets that he had to his name. He has $100,000 in a tax-free savings account and $400,000 in a RIF. Now, both of these assets would transfer over tax-free to Sandra. Bill also has a pension that was paying him $2,000 per month. Now, upon his death, Sandra would still receive 66% of this, or just over $1,300 per month. His CPP was paying him $1,000 per month, and Sandra would be entitled to $600 per month from this amount moving forward. So why is Sandra receiving $600 per month from Bill's CPP? To find out what you and your spouse would be eligible for in the event of a death, check out the video we put together on the CPP survivor benefit. Bill was also receiving the old age security pension, which was paying him $685 per month. Unfortunately, once Bill passes away, Sandra would not receive any of this amount moving forward. To summarize, upon Bill's death, the family, or Sandra in this case, would be receiving $1,800 less per month. However, Sandra might not need this $1,800 a month because now she only has herself to worry about. So she can get away with spending $1,800 a month less than before, then life insurance isn't really necessary in this case. For most retirees, life insurance is not necessary because they have minimal debt or the income that the life insurance would protect is not worth insuring. However, if you carry large amounts of debt into retirement, or if you have a substantial amount of income that would not transfer over to your spouse, then life insurance can still be used to protect your family. So as mentioned, the first reason to have life insurance is to create an estate and make sure that your family is taken care of. Now, the second reason to get life insurance is to protect your estate. Families with significant amounts of assets may be facing a substantial tax bill upon death. In these cases, life insurance can be used to offset the tax liability. Let's run through another example. Jim and Bertha are both 70 years old and they have put together a tax and retirement plan with their advisor. And they've determined that once they are both 90 years old, they will be facing a $500,000 tax bill upon death. A life insurance policy can be used to offset this tax liability. Let's say that Jim and Bertha buy a joint last to die life insurance policy that would pay them $500,000 upon death. The cost of this policy would be just over $13,000 per year. If they both pass away after 1 year, they would have paid just over $13,000 into this policy, and the estate would have received a tax-free payout of $500,000. Now, let's say they didn't have this policy and they had invested this $13,000 in a joint non-registered account instead, and let's assume they were in a 50% tax bracket. That $13,000 would have had to grow by over 15,000% to pay him out $500,000 after tax. If either Jim or Bertha lives to 90, they would have paid over $260,000 in insurance premiums for the same death benefit of $500,000. Had they invested this money, again in a joint non-registered account at a 50% tax rate, this would have been equivalent to receiving a 6% rate of return on their premiums. Now, if one of them happens to live until 95, the rate of return on their premiums drops to 3.2%. Depending on when you pass away, these types of policies may or may not make sense. So do you need life insurance once you're retired? For the majority of people, I would argue no, unless you have a large amount of debt or a substantial income that won't transfer over to your spouse upon death. If you want to use life insurance to cover a large tax bill, it may make sense but becomes less attractive the longer that you live. Carefully consider your financial situation and consult with your advisor before making a final decision. I hope you enjoyed today's video. Hit that subscribe button and we'll see you next time.